My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends. I'm just trying to make you a little money. My job is not just to entertain you, but to educate and put days like today in context. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Well, it sure took long enough. Now, let's see. We've had 8 rate hikes from the Fed, a couple 25 basis point hikes, 2 50s and 4 75s, delivered with the speed of a machine gun. Yet Fed Chief Jay Powell hasn't hit anything until today. Today, we realize that the speed of the rate hikes is threatening commercial real estate, crypto, and the whole startup economy, thanks to the closing of the IPO market. That's a real casualty of this Fed tightening cycle. So what happened to today? What caused the reversal from a usually green board in the morning to a board that's drenched in red, with the Dow plunging 544 points, S&P plummeting 1.85%, and the NASDAQ nosediving 2.05%? Simple. The bank stocks collapsed. All of them. Big, small, regional, national, lending, savings. It didn't matter. See, these aren't the battlegrounds where the Fed wanted to fight inflation. Remember, that's about wage inflation that they're worried about. But it turns out they're the battlegrounds where the Fed's suddenly winning. How did it unfold? Boy, I heard a lot of misinformation, but I'm not going to let you get away with that. I'm going to tell you the truth about what happened, because I have been through 3 bank scares in my career, and I'm going to give you all the information I have now, which is going to be steeped from that knowledge. First, we are beginning to get a slew of furious downgrades of the commercial real estate investment trust. We're seeing worried notes about SO Green, Vornado, 2 once giant, now tiny office REITs, because of the pending collapse of commercial real estate, thanks to the persistence of, work from home. It's all about the remote economy again. It doesn't matter that the real problems are only concentrated in a couple of cities, and that's notably New York and San Francisco. It doesn't matter that the buildings are old, not of great use to anybody, maybe other than its residential properties. The market's woken up and decided that every bank that has commercial leases, meaning pretty much all of them, will get crushed by those commitments. I do think that this part of the equation is overblown. There's a lot of good buildings out there. But we are indeed watching the train wreck right now of WeWork play out again. Can you believe it? This time with a difficult debt restructuring that I don't even know what's going to happen. We don't know how things are going to pan out here, but I think this segment will be contained. That was considered wildly bullish today. No matter, every bank stock under the sun got obliterated. Welcome to day 1 of the commercial real estate pandemic. Of course, it's not just commercial real estate portfolios that may be at risk. For instance, we learned today that SVB Financial, that's the parent company of Silicon Valley Bank, had to raise $2.25 billion in one day. That's a tremendous fundraise. One day. Because it had some very serious portfolio losses. It shocked everyone because this is a very good bank. Not expected to have many problems. I'm used to these guys. They're I don't know, pretty sturdy, I thought. Now, these losses weren't real estate related. They're IPO related. See, SVB Financial has a long history of being the banker to the future stars, the startups that are about to have initial public offerings in the not-too-distant future. Great business normally. But what happens if they can't come public because there's no appetite for IPOs? Well, hold it. That's exactly what's happening now. Suddenly, venture backed companies that looked like they were sure bets to come public soon and soar, well, they're now very risky. Suddenly, loans made against those sure bets, illiquid, not yet public, common stock, that was the collateral, they're even riskier. We didn't know how risky until today, when this outfit copped to needing more capital to prop up its reserves. Now, we don't know how much, but we know there's now the possibility that the next Bill Gates or Jeff Bezos may not be able to pay back their loans that they made against future stock that was going to come public and be, red hot. And the collateral will end up being maybe much less than the companies they work for if they can't come public. Look, think about it. if you can't come public and every day you need more money and you've borrowed money against that common stock that you hope would come public one day, well, you're in a real jam, aren't you? What happens if you need more money? Well, this is what happens. We also learned that SVB's Financials owns investments, their own investments in their balance sheet, namely the billions of dollars of treasuries out 3 years that they had are way underwater now. Yeah, the Fed raised them that quickly. As the bank scrambled to sell more than $20 billion of those securities, it locked in a loss of roughly $1.8 billion. Hence, they had to raise a lot of money. Because they need capital now. They had to sell those treasuries at depressed prices rather than be able to keep them till they came due. Now, mind you, in any other market, treasuries bought out 3 years and change wouldn't be underwater and wouldn't require losses to be taken and capital to be raised. But when you think about it, we're not in just any kind of market. The Fed's incredibly rapid rate hikes are finally starting to bite. They're beginning to wreck once seemingly ultra-safe portfolios of treasuries, bought even as recently as years ago. That's how quickly bonds have gone up in yield and down in price. So SVB's stock plummeted a bone-chilling 161 points. Extraordinary, 60%. But was that an overreaction? Not really, because until this morning, I didn't have any inkling that there was anything awry, nor did almost anyone else. The collateral damage to the rest of the banks was profound, because not only did we start fearing their commercial real estate loans, we also became petrified about loans made to people in venture capital-backed firms that may not make it. And suddenly we had to worry about how underwater their Treasury portfolios might be. Treasury is supposed to be the closest thing to a risk-free investment out there. But they're not risk-free if you have to sell them before they reach maturity and you get the principal back. Finally, crypto's become a pain point again, because the First National Bank of Crypto, also known as Silvergate, had a bank run and is now being wound down. How'd that happen? Just as SVB was the banker to Silicon Valley startups, Silvergate was the banker to crypto exchanges. While crypto prices have recovered from the FTX fiasco, all sorts of crypto-related businesses keep imploding. So the Bank of Crypto never really recovered. Now it is gonzo. Gonzo as in ain't got nothing for you. Now, few banks are like Silvergate, but some are indeed like SVB. I think SVB's been overly punished after today. But who cares? I mean, let's think about it. The fear is just too palpable. I also think the pin action in the rest of the bank stocks is too severe. But unlike most public companies, the financials, they can't defend themselves. They can't say, hey, buy us, we aren't in trouble. Because trouble's determined by the regulators, not them. And the regulators are never going to go out on a limb for the banks. That's why when you see the banks getting shelled, you don't instantly say, aha, let's go buy the stock of JP Morgan, which I actually think is in good shape against any commercial real estate issues. And they didn't make risky loans to startups, and they wouldn't even accept my crypto, which is at last collapsing, although I don't have any now. Again, I'd love to say that it's too early. It's too early. We just had day one of the recognition of how fraught banking stocks can be. Let's give it a couple days. However, don't forget, the market wasn't indeed flying this morning before the bad banking news overwhelmed the tape. It was flying because we got a weak jobless claims number at 8:30 this morning, causing interest rates to finally come down. Weak economic data is a sign that the Fed might not need to tighten as aggressively going forward. Good news for stocks. But SVB and Silvergate cast such a pall over the market that it swept all the optimism out the door. Will it change tomorrow? First, we have to endure the travails of a once large European bank, Credit Suisse, which just had to delay its reporting after a last-minute SEC inquiry. Never a positive sign. Then we need to see that February employment number. It's pretty good. If it's cool in any way, shape, or form, I think there could be plenty to buy, because I simply don't expect a flurry of SVBs or Silvergates, because they are indeed niche players that collapse. They're niche. They're not broad. They're not representative of the industry. And they'll be in the rearview mirror soon enough. I'm not sanguine about the cascading regionals or of Schwab, which was off big today. But I am staying open-minded as my Travel Trust just doesn't have enough good bank stocks, and I'm on the lookout for one. Bottom line, keep your eyes on the non-farm payroll prize. A weak jobs number means it's time to invest in fast-growing tech stocks when no other SVB or Silvergate-like disasters unfold. Eventually, even the bank stocks will be worth buying. Not yet, as traders think there'll be plenty more issues to come. But soon, if the Fed no longer has to keep up this Metallica jam session of rate hikes, we have to start doing some buying. Let's go to Dawn in Michigan. Dawn.
Hello, Jim. Booyah. Thank you for taking my call.
Booyah, Dawn. How are you?
I'm good. I wanted to know if I should buy more, hold, or sell my stock in Johnson & Johnson, and what do you think the future holds for the stock?
Okay, this is one of the worst runs on J&J I've ever seen. Some of it's related to talc. We own the stock, unfortunately, for a charitable trust. I've liked it so many years. I just think it's a good 3% yield. Yes, I know it's got lawsuits. I know that they've been winning the lawsuits. The company is splitting up. I don't think you're ever going to get this stock for less than 14 times earnings. I think you have to buy J&J. I've been wrong for my charitable trust on J&J. But at 3% yield, I would buy this stock. It's down 14% like that. Let's go to Russell in New York. Oh, no, we don't have any time for more calls because I went on so long about the banks, and I apologize. And I apologize for my throat. I tried to raise some money for a very important cause that my wife's involved in last night, and I shot my vocal cords. A weak jobs number means it's time to invest in fast-growing tech stocks. Eventually, even the bank stocks will be worth buying, but oh, not yet. On Made Money Tonight, one of our favorite technicians, Larry Williams, has a new call on AMD. I'm digging into the charts and sharing what he's seeing. Then, the snacking theme is back and better than ever. A welcome break from the banks. So where do I come down on my favorite stocks in the group? I'll give you my take. And on a day like today, where the market gets crushed, you have to look for some names that can hold up in the face of volatility. So I'm reviewing some dividend antidotes. Yes, I think your portfolio can always use one of those. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.